Welcome to The Explainer. Today, we're diving into a genuinely fascinating breakdown of a massive financial portfolio, one that was built completely against the grain of traditional wisdom. We are going to look closely at the investment journey of Gajendra Kothari. He's a veteran wealth manager who built an absolute mountain of wealth by fundamentally breaking the rules that most of us think we need to follow to get rich.
Now, when you picture a multimillionaire, you probably imagine a lavish house, a fleet of luxury cars, and a safe full of gold, right? Well, Gajendra Kothari operates totally differently. While traditional wealth screams home ownership and precious metals, Kothari happily pays 3.5 lakhs a month to rent an apartment in South Bombay. He doesn't even own a car. He just takes the local train to the office. And despite massive recent rallies in gold and silver, he holds exactly 0% of his portfolio in those assets because he believes they're in bubble territory.
And listen, this unconventional, train-riding, renting lifestyle, it is absolutely not because he's short on cash. Quite the opposite. This extreme frugality, combined with a relentless investment strategy, has resulted in an astonishing net worth of 62 crore rupees. Yes, you heard that right, 62 crores.
So how exactly did he do it? We're going to deconstruct his strategy through 5 core pillars. First, the 62 crore paradox. Second, the math of compounding. Third, his contrarian playbook. Fourth, a look inside the portfolio itself. And finally, how he survives and exploits market volatility.
Let's start with Section 1, the 62 Crore Paradox. What's really wild about his setup is the true power it gives him. Because his portfolio generates such consistent compounding returns, he can operate on a safe withdrawal rate of just 1%. Mathematically, 1% of his portfolio equals 60 lakhs a year. That means he could literally live in the presidential suite of the Taj Mahal Palace Hotel for the rest of his life without ever depleting his principal amount. It's a stunning way to visualize what absolute financial independence actually looks like.
Moving on to Section 2, the math of compounding.
Now, his journey to 62 crores was definitely not a straight line. Look at how a 16% compound annual growth rate just drastically accelerates things later on. He started back in 2010 with a really modest 10,000 rupee monthly SIP. By 2014, he hit his first crore. By 2020, he was at 6 crores. And then, the compounding curve just went completely exponential, skyrocketing up to 62 crores by 2026. Obviously, as his business grew, his monthly investment scaled up to a massive 42 lakhs today. But it's really the compounding effect on that base capital doing the heavy lifting.
But wait, here is the absolute jaw-dropping part of this whole story. At the very bottom of the March 2020 market crash, his net returns, after 10 full years of disciplined investing, were actually negative 25 lakhs. Can you imagine that?
Let's just pause and absorb that brutal reality. 10 years, 6.1 crores of his hard-earned money invested, and the total portfolio value had sunk to 5.85 crores. Most people would panic, right? They'd sell everything and claim the market was rigged, but not Kothari. He stayed incredibly patient. He didn't sell a single unit. Instead, he dumped a lump sum of 1 crore directly into small caps right at peak panic.
Which brings us perfectly to Section 3, the contrarian playbook.
This is the psychological engine driving his massive success. His philosophy is so simple but so hard to execute. While the whole world chases yesterday's winners and buys the top-performing funds, he is actively looking for the 1-star or 0-star funds. While retail investors chase past performance, Kothari is out there seeking the absolute worst-performing sectors to find cheap valuations. He truly believes that by the time an asset is making front-page headlines for its massive gains, the margin of safety is completely gone.
So, he actually uses a strict 3-step playbook to allocate his capital, essentially buying quality assets when they are universally hated. Step 1, he tracks down fund managers who have survived multiple market cycles with at least 15 years of experience. Step 2, he intentionally picks their worst-performing funds over the last 3 to 5 years. And Step 3, he sits down with them to verify they're sticking strictly to their investment style and, crucially, putting their own money into the fund.
And these highly uncomfortable bets have historically turned into massive multi-baggers for him. For instance, he completely ignored gold's recent 50% rally because he saw it as a bubble. He threw that full crore into small caps during the extreme fear of March 2020. He aggressively bought highly criticized China funds in 2021 and 2022 when literally nobody else wanted to touch them, raking in huge profits. And he recently cashed out of PSU funds, which are government-owned enterprise funds, at a staggering 56% compound annual growth rate after 4 years, just so he could rotate that capital into cheaper sectors.
So what is he doing right now in 2026? He's basically waiting for the pendulum to swing back by heavily accumulating unloved sectors based on his heat map analysis. He's placing major contrarian bets on banking and financials, which have lagged recently. He's loading up on the heavily corrected Indian IT sector. And he's buying into quality and momentum factor funds, which pick stocks based on strong balance sheets or upward trends, while the broader market mostly ignores them.
Let's dive into Section 4, Inside the Portfolio.
Let's break down the actual math of how this 62 crore portfolio is split up today. Looking at the macro level, he keeps a very aggressive 80% in equities, mostly through mutual funds and portfolio management services. But here is the key. He keeps the remaining 20%, which is roughly 10 to 12 crores, entirely in liquid or debt funds. That is his dry powder, just sitting there waiting for the market to crash.
Now, within that 80% equity chunk, his risk appetite heavily skews toward volatile small caps and concentrated bets. 30% is in small cap funds. Another 30% is locked into those thematic bets we mentioned, like China, IT, and financials, and the remaining 40% acts as a slight anchor in large and mid-cap funds. It's a highly aggressive setup engineered for maximum growth.
But despite making all these aggressive bets, his ultimate secret weapon is just doing nothing. He refuses to interrupt the compounding process unnecessarily. He limits his portfolio turnover to maybe 1 or 2 transactions a year. In fact, many of the funds in his portfolio have been held for over 5,000 days. Think about that. That's nearly 15 years without selling a single unit. This brings us to our final section, surviving and exploiting volatility.
We really need to understand exactly how he weaponizes market fear using that 20% cash reserve. He uses strict, totally emotionless rules. If the broader market index drops 5 to 10%, he does absolutely nothing. If there is a 20% drop, he deploys 40% of his cash reserves. And if the market crashes 25 to 30%, he goes all in, deploying 100% of his dry powder straight into equities.
The main takeaway here is that a 50% market drop isn't some huge tragedy to him. It's a generational buying opportunity. He actually loves seeing his portfolio temporarily bleed value because it means he gets to scoop up high-quality assets at blowout sale prices.
This is the ultimate test of an investor. Ask yourself, if your portfolio is in the red after 10 years of disciplined investing, would you have the conviction to keep buying? Because passing that exact test is how he projects this portfolio will hit 1,000 crores over the next 15 years. You have to decouple your emotions from the daily red and green numbers on your screen.
We're going to leave you with a provocative thought from financial author Nick Murray, which is basically Kothari's guiding principle. To suppress volatility is to suppress returns. So think about this today. Are you sacrificing massive long-term wealth simply because you're too afraid of short-term volatility?